Hey, what's up guys? John here. The Federal Reserve has now officially hiked rates. Here's exactly what Jerome Powell is doing. Here's what he says about the economy.
Period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight and inflation is much too high. Against this backdrop, today, the Federal Open Market Committee raised its policy interest rate by 0.75 of a percentage point and anticipates that ongoing increases in that rate will be appropriate.
Think about what this means. 0.75%, right? Well, what do we have here in this economy? We have a debt-ridden society right now in America. Unfortunately, $1.1 trillion in credit card debt is just going to get more expensive to service. $1.46 trillion in auto loan debt, more expensive to service. Student loan debt, $1.7 trillion, more expensive. Everything is going to get much, much more expensive. And what does this mean for small business? It means that for them to grow their business, they're going to have to spend more to get access to that money if they can get it at all. So small business is going to pay more to stay in business and to expand their business. And with that, they have rising wages. Everything's getting much more expensive for them to stay in business. So we're going to see a very, very different dynamic unfold here in this economy.
In addition, we are continuing the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Overall economic activity edged down in the first quarter as unusually sharp swings in inventories and net exports more than offset continued strong underlying demand. Recent indicators suggest that real GDP growth has picked up this quarter, with consumption spending remaining strong. In contrast, growth in business fixed investment appears to be slowing, and activity in the housing sector looks to be softening, in part reflecting higher mortgage rates. The tightening in financial conditions that we've seen in recent months should continue to temper growth and help bring demand into better balance with supply. As shown in our summary of economic projections, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth running below 2% through 2024. The labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies at historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 408,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. FOMC participants expect supply and demand conditions in the labor market to come into better balance, easing the upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises somewhat over the next few years, moving from 3.7% at the end of this year to 4.1% in 2024, levels that are noticeably above the March projections. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in April, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core prices rose 4.9%. In May, the 12-month change in the Consumer Price Index came in above expectations at 8.6%, and the change in the core CPI was 6%. Aggregate demand is strong. Supply constraints have been larger and long-lasting than anticipated, and price pressures have spread to a broad range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is boosting prices for gasoline and food and is creating additional upward pressure on inflation. And COVID-related lockdowns in China are likely to exacerbate supply chain disruptions. FOMC participants have revised up their projections for inflation this year, particularly for total PCE inflation, given developments in food and energy prices. The median projection is 5.2% this year and falls to 2.6% next year and 2.2% in 2024. participants continue to see risks to inflation as weighted to the upside. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation.
It's not just high inflation. We have these rising gas prices. So they can increase interest rates. Sure, that's going to have a big impact on how much people spend, but it's also not going to touch at all the gas prices and all of the new built-in costs around these prices, whether it be food, whether it be any items that we have in our house. Anything that we buy comes in on trucks. And if it costs more for those trucks to deliver those items, we're going to get those costs passed down to us as consumers.
We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Against the backdrop of the rapidly evolving...
So they want to take it to a 2% objective. That's what he says, 2% objective. They now say that real inflation is about 8.6%. And then we've increased 3/4 of a basis point, or 0.75% of the way. So what are we going to likely do? We're going to see another hike, another hike, another hike. It may get more and more and more aggressive as time progresses, which we could see rates that, we maybe have seen 20 years ago, 30 years ago, where we start seeing double-digit rates again. But it's a different dynamic, a different economy than back then. Back then, people, they were buying homes for $100,000 or $50,000 or $80,000. Now people are buying homes for $800,000, and they're strapped in debt. And so this is going to age much differently than what we've seen in the past.
Economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, resulting in a 1.5 percentage point increase in the target range so far this year. The committee reiterated that it anticipates that ongoing increases in the target range will be appropriate. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Coming out of our last meeting in May, there was a broad sense on the committee that a 0.5 percentage point increase in the target range should be considered at this meeting if economic and financial conditions evolved in line with expectations. We also stated that we were highly attentive to inflation risks and that we would be nimble in responding to incoming data and the evolving outlook. Since then, inflation has again surprised to the upside. Some indicators of inflation expectations have risen, and projections for inflation this year have been revised up notably. In response to these developments, the committee decided that a larger increase in the target range was warranted at today's meeting. This continues our approach of expeditiously moving our policy rate up to more normal levels, and it will help ensure that longer-term inflation expectations remain well anchored at 2%. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 3.4% at the end of this year, a percentage point and a half higher than projected in March, and 0.9 percentage point above the median estimate of its longer run value. The median projection rises further to 3.8% at the end of next year and declines to 3.4% in 2024, still above the median longer run value. Of course, these projections do not represent a committee plan or decision, and no one knows with any certainty where the economy will be a year or more from now. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on the incoming data and the evolving outlook for the economy. Clearly, today's 75 basis point increase is an unusually large one, and I do not expect moves of this size to be common. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting.
We're going to see a whole new economy here. As we really start tightening this up, what's going to happen? Those that have fixed debt, they're going to be okay if they have the income to support it. Those that have large cash savings, obviously, you're going to want cash, you're going to want credit, you're going to want a plan. You're going to want to really have a strategy, because what's ultimately going to happen here is we're going to likely continue seeing these 50 basis points, 75 basis points. Wouldn't surprise me to see a full basis point hike where we increase by 1 full percent.
We will, however, make our decisions meeting by meeting, and will continue to communicate our thinking as clearly as we can. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment.
So that's what's going to happen. They're dropping the hammer. They are rug pulling this entire economy. But I'm wondering, where do you see this going? Q3, Q4, 2022, what do you see this looking like? What do you think Q1 of 2023 is going to look like? I think we're going to start seeing banks really tighten up on lending, on available liquidity for mortgages, for financing. They're going to really start trying to take risk off of the table here. But, again, this is why you want great credit. This is why you want to have a plan, a strategy, and cash reserves. You want to have multiple streams of income. You want to get ready, because when things hit the fan, people are going to need cash. They're going to want to sell things, whether it be watches, art, cars, real estate, land, whatever it may be. People are going to need money. And so if you have cash and you have credit and you can make it happen, then you're going to position yourself well. You need help? Cashnow.video. Subscribe. You're also subscribe to my second channel. It's going to be an interactive call-in show this upcoming week. We're going to be able to call in, talk with me about real estate, the economy, business, and follow me on Instagram, TikTok, LinkedIn. Everything's in the banner up top, and I'll catch you guys in the next video.